Most of us learned Wyckoff for the first time by searching on Google Wyckoff methodology or Wyckoff pattern, and we were probably amazed by the theory on how the smart money is manipulating by creating an accumulation or distribution schematic. So right away we go copy paste that pattern and put it into the chart and try to take trades based on that pattern. I'm not against patterns, but the problem is that the participants that led to the creation of every pattern that we see in the markets are different every time we spot them. Excellent news for everyone. Today is Black Friday, so if you want to participate in our awesome mentorship, we have up to 50% discount for you guys. So make sure to check the link in the description. And now let's continue with the video. Every time price is about to reverse an existing trend, for example, an uptrend to a downtrend, usually there is a consolidation period at the top of this trend where smart money is accumulating shorts before pushing the market much lower. This process is called distribution, and what they do is accumulate as many buy stops as possible by shorting at the market. And when price is on a downtrend and they are about to reverse to the upside, what they do is accumulate as many longs as possible by absorbing sell stops. Now, this is one of two main processes that happen on any Wyckoff schematic, and it's extremely important for you to deeply understand the reasoning of why this is happening. Why does a Wyckoff accumulation pattern looks like this and a distribution pattern looks like this? What is happening behind the charts, behind the candles? Well, let's assume that we are on a downtrend and price is about to hit a bullish point where smart money is willing to push higher. This formation is only known by smart money. Most of the market participants are not looking at this level because it is invisible for them. So most people out there will be shorting because we are on a bearish market. At one moment, what smart money start doing is accumulating the shorts that these people are putting into the market, the less informed traders, by longing at market. That means that every time price makes a lower low, the sell stops that are sitting below this level because of breakout traders trying to short, or because there are some buyers trying to long from here and they are placing a stop loss below this level, are being absorbed every time price makes a lower low. And there is a very common characteristic for any Wyckoff schematic, which is called the shortening of the trusts. So basically, every time price is making lower lows, and coming back inside of a trend range or inside of the consolidation, if we measured the length of each one of these lows, you will see that it's getting shorter and smaller. This doesn't always happen, but it's a common characteristic for every Wyckoff schematic. So the idea here with this very first mechanism is absorb as many sell stops as possible before turning around the market. Now there is another mechanism that is called inducement. When price is about to reverse, usually smart money creates a bearish sentiment by inducing sellers to get into shorts. How do they do that? Well, by creating what is commonly known as a trend line, or for example double tops or triple tops on the case of an accumulation. So you will see a price starts doing this process is that they create the illusion of a resistance levels for sellers to step into this market, and this selling pressure is absorbed over and over again by smart money until they completely reverse and push higher. This process is not only to accumulate, but also because all of the stop losses from these sells are placed usually above the resistance levels. So imagine how many people out there are selling and placing a stop loss at this level. A lot. And what is the stop loss of a sell? It's a long. Imagine that when smart money finished accumulating longs, when they push higher, the stop losses from these sellers are getting triggered at the same time, producing what is commonly known as a short squeeze. Like what happened with the stock called GameStop, when everyone was shorting and suddenly price starts breaking a lot of different quote-unquote resistance levels and everyone starts hedging longs, or the stop losses from the sellers are getting triggered, allowing price to push higher faster. And that's why usually when we see a finished accumulation process, this is the path of less resistance that price takes and starts moving very fast to the opposite side. One of the most important steps to analyzing and comprehending a Wyckoff schematic is understanding the process of changing the character. Change of character happens when we are, for example, on an uptrend and price soon starts changing that uptrend into a downtrend until finally we have a breakout market structure and price initiates a downtrend. Well, we are talking obviously about a distribution like the one we are seeing in this example. Now, there is a very key moment in this uptrend that will help you understand that smart money is telling you, giving you this tip that there is a consolidation starting and you need to start analyzing the chart as a consolidation instead of an uptrend. And that moment is when the down waves are getting bigger and bigger and bigger compared to the previous down waves. This is a very simple way of analyzing the waves. The first down wave that retraces 100% from the previous up wave, which in this example is going to be this one, is going to be the change of character. So as soon as this happens, you split the chart into two parts, on the left and the right, and from this point on, you will analyze it as a Wyckoff schematic. Now, this is a trading range or consolidation where smart money is going to be accumulating orders, manipulating the price, grabbing liquidity before they push price into the opposite direction. So this trading range can be determined by the lowest low and the highest high within the consolidation. Now, this is the very first moment, the first change of character, and then we have the second change of character that will tell us that this schematic is over. And that second change of character happens with this break down here. Now, how many times have you tried to trade this way and price then, boom, went higher again? Well, this is happening because you're missing a very key important information which has nothing to do with the graphical pattern, and it is volume. The law of effort versus result is extremely important for Wyckoff. If you treat Wyckoff without volume, it's like trading any other pattern, and you know that patterns doesn't always work. So ideally, what we want to see is volume supporting the effort being done in such a way that we comprehend that smart money is accumulating shorts and not longs. Because if most of the volume is situated at the bottom of the range, aka a discount level, is because smart money is probably accumulating longs. But if volume is most of the time at the top of the range, that means that smart money is probably accumulating shorts. I won't get deep into volume right now because it's a very extensive and complex method. I teach it on my mentorship, so you are welcome to join my mentorship where you will learn exactly how I trade, from top-down analysis to execution, trade management, and everything you need. But think of volume as the effort being done to move price. If there is no effort on any given move, it's because nobody is trying to push price. Now let's analyze the chart I sent yesterday for USD. I was looking to long. I spotted a nice accumulation schematic, and once that accumulation was over, I sent the chart and the trade ended up working perfectly. You can see here we have a downtrend on USD. This is very recent, so you can go and check it out on your own chart. On this downtrend, I spotted this change of character. We have a down wave and then an up wave that retraces 100% here. So from this point on, I began to see the chart as a Wyckoff schematic. And then we had a spring and then a break of market structure. If we look at the chart now of what happened, you can see that after that break of market structure, price retraced, testing the spring and then continuing higher until it hit my target, which was this level right here. But what is the most important part about this? Volume. Volume is, like I said earlier, the key to understanding Wyckoff. Nowadays, what I do is I look at volume. I don't even pay much attention to the labeling of the schematic, but rather to the volume and the waves. What is that telling me? Just to give you a heads up of how I analyze the chart, you can see here that on this change of character, there is high volume pushing higher. This is telling me that smart money, for some reason, are longing either to take profits from shorts or because they are accumulating longs. After this move up, they breaking the structure here, inducing buyers. At the same time, they are inducing sellers. How do they induce sellers? By creating, in this case, a double top. You can see we have perfectly equal highs here. This is seen as a resistance levels, and after price fails to break the resistance level over and over again, who do you think is selling from this level right here? Less informed traders, or from around here or even down here. So they take advantage of that selling pressure coming lower to absorb them as longs. Smart money continues longing down here. We have sustained high volume at the bottom and price not going lower. If smart money was selling and we have so much effort being done, price should have continued going lower, but instead it failed. And then finally we have the second change of character, which is all of this wave up, again retracing 100%, and in this case breaking the trend range, which was determined by the highest high and the lowest low. After this break of market structure here, I decided that this was ready, this was a low that was very likely going to hold, and I was expecting a move much higher as a first TP down up here and second TP up here, and you can see a price has reached both of those levels. Here I have another example of a trade I analyzed on one of this week's live session. We were looking at GBPJPY, and I spotted a change of character. The first one that we can see here, we have a 100% retracement on a bullish trend. This is telling me that the smart money is getting into sales for some reason. So what I did was waiting for this schematic to be over. We have a manipulation going higher, equal highs and equal lows. So they are inducing sellers and buyers. They take out the sellers by pushing higher, and then we have the second change of character, another way that ends up breaking the trading range. So at that moment, I assumed that the most probable scenario was for price to retrace to a premium level in this point of interest and continue setting up from here. When price got to that level, I called a beautiful trade during the live session that ended up hitting 10 hours as maximum.